Welcome back in this new video. Those are the four analyses we're going to see. Payout probability first, and then prop firm challenge success rate, and then portfolio analysis due to news, and then drawdown analysis. So let's start with the equity line with all of the news. This is the third analysis we're going to do just to show you how it's going to look like, and this is very useful. But then I'm going to apply machine learning to analyze everything for me, because those are a lot of information all together. During 6 year, you have like around 3 news each month, so those are a lot of news all together. I'm gonna apply machine learning for that. But now let's start with probability of my portfolio to achieve the first step and second step of challenge, prop firm challenge. So you have here the different scenario. So this is 10 plus 5, and then you have 8 plus 5. Those are the, let's say, FTMO and funded next or something. So it's the one you have to achieve first 10% and plus a 5% after, and this is like the 8% first and then 5% after. I'm going to go deep on this analysis because all of the new prop firm are offering this type of scenario. So basically this is all based on my portfolio, and of course is equity based, because when you analyze those type of target, you have to think about that the equity is always detaching from your balance level. Okay, so if the balance is 10,000, the equity is the one, it says 10,500 when you're in profit. Okay, so you have to analyze that and not the close position, because with the open position you can easily reach the target a little bit quicker. So all those numbers are equity based, and this is the scenario with no multiplier on my risk. So this is like my portfolio. This is converted to euro, and basically I'm taking as a sample a 50k prop firm challenge. The first target is like 4,000 USD, and the second target is 4,000 USD plus 2,500. Okay, and this is converted to euro because my portfolio here is in euro. So basically I'm gonna have a 50% chance of passing my first step, so like the 4,000 USD with my risk and my portfolio in 40 trading days. So it's like not counting the weekends. So this is around 2-3 months. So basically 50%, that's very low because my portfolio is doing really well. And with this same risk, I'm going to show you later, I also analyze the failing. This type of risk is very low, my failing rate, so the failing odds are very low. Okay, but of course also the success rate is really low. I think this is not useless, but I'm in a position where I don't care if I'm losing one challenge, maybe 2, 3 in 1 year. So why not to increase my success rate? Okay, where we are gonna get like a good success rate here, but it says 90 days. Okay, this is a lot of time. I don't wanna lose all of this time, because time is equal profit for my portfolio since it's doing really well. And yeah, definitely after this type of analysis, what I could get out is that I need to increase my risks. So in these two different scenario, you're going to see the performance improve a lot. This is a 1.35x my first risk, and so you're going to see that like with the same time horizon of 40 days, from 50% we're going to achieve around 70%. Okay, 67, that's good amount. Is like around 17% more. But if you move to, let's say, 50 days, you're gonna hit 80%, and compared to the 62, that's way better. Okay, but we can easily do more because this is calculating just the first challenge. Okay, so the 8%, and the 8% plus the 5%, it says that in 50 days I still have a 50% odds to achieve it. Okay, I could increase the risk more, but like now I'm gonna show you why I'm doing and taking this type of multiplier. Okay, because I analyze them. So basically this is like a quantitative analysis of my risks. It's the same thing as this one, but in this case I'm analyzing the maximum adverse exposure. Okay, so the drawdown phases about my equity and not about the balance, because like when you analyze the drawdown, you have to analyze the equity drawdown, not the balance drawdown, because it's different. So you're looking at the worst scenario, not the best scenario. So basically why I said those numbers, so this is the 1.35, and with the 1.35 I'm going to hit one fail each year on average. Okay, so those are not perfect number, and I cannot rely on those number perfectly, because if you run multiple Monte Carlo simulation, you could have, with this type of risk, maybe 2 or maybe 3 in some cases, random scenario, you could have 3 times this type of failing rate, okay, but I'm still fine, okay, I'm really fine with this type of risk. And then you see that like with 1.63x, the failing rate each year is going to be close to 2, because if you look here, this is the odds that is increasing by the multiplier it is increasing, so it means no risk. My probability to fail, those are the number of fail that I could have, okay, is like less than 0.5, okay, so it's like there is a 30% of half of a fail each year. It means like one fail, let's say one fail every 2 years, okay, but still with a 30% odds, so very low. Now the goal is to look around the middle of this graph. It says conservative 1 fail a year, that's good, and that's the 1.35x. But still with the 1.35x, I showed you that like we're not getting insane performance, because like we only get like a 80% chance of passing both phases in 80 days. That's still a lot of time, okay? If you know that times is equal money when you have something that work, you want to increase the odds of passing the both phases. And so that's why I got like the 1.6. The 1.6 is actually here and is a little less than 2 times failing each year. So let's say 1.9, but it still is around 2. So you're approximating to 2. And then you have the odds. Actually here the odds are pretty good, because like it doesn't say you have 100% odds of failing 2 times each year. You only have 6%. So it doesn't mean that you're going to fail each year 2 times. As I said before, as I'm trying to be as transparent as I can and also very analytical and math driven, okay, I'm not going to believe that I can only get this type of failing each year, because if you run Monte Carlo simulation, what they are going to do is taking all of your trades, let's say this portfolio it took 6,000 trades around, and mix them all together, okay? So I think I could, with this type of risk 1.6, I could easily get to 2 drawdown, max drawdown each year, okay? So I'm fine because I know the odds. And so with the 1.6 and this type of challenge, so 8 plus 5, we're getting very good insights. Let's look at the 76, because 76, it means 1 every 3 challenge. I'm going to pass it with 40 days. That's very good, very good. Basically, I'm getting also a 50% odds of passing both phases only in 40 days. And here I got around 90% of passing both in 80 days. So I'm getting something much more useful in this scenario. And yeah, that's pretty much it. I think I showed you everything. This is very important. The challenge success rate is really useful, because like you understand how to handle probability. But also here, this one I think is much better, because if you know how many times you can fail, okay, you can adjust your risks on your comfort level. Let's say I know that if I'm using this type of risk, I'm going to increase my success rate. But then of course, I like with the risk, more reward, okay? So if I'm increasing the reward here, of course I'm going to increase the failing rate in this case. But as I told you before, I'm totally fine with this because my portfolio is working. And yeah, that's pretty much it. This is an update video. In this case here, you're going to see different thing. First is like news analysis, and then we're going to see the MFE distribution, where the script is going to analyze only the maximum favorable exposure, so the one we really need when we need to analyze profit target for profit. When you want to have a payout, okay, you need to analyze the MFE. And then payout probability is very useful because it's giving you more odds to withdraw money, because you know that like during the last 6 years, your portfolio on average with 70% of confidence, it made around, let's say this is like 1k in euro. So yeah, and then you do all of your calculation based on that. So let's begin with the equity comparison with this if scenario, okay? And in this case is I use machine learning. Now I don't have the code here. It should be this one. okay, news impact and impact analysis. And basically, what is the concept? I decide how to manage different news scenario. Okay, so this is no FOMC before and after 60 minutes. This is the same thing for 15 before and 15 after, and the same thing for NFP, CPI, and NFP for different minutes. And in the end, those are the equity line. My portfolio with all of my algorithms and different strategies is performing better with all of the news, even if sometimes it's not benefiting, so it's like losing a little bit more money, but overall, over 6 years, it did perform better. And as you can see from the equity, the blue equity, you'll see that each single year, the equity is detaching more and more from the other. Okay, so that thing means that it didn't perform better only once, but it performed better year over years. Okay, that's very useful insight because I didn't know, and I was looking for an answer because it's very hard to analyze that by doing it manually. This is the analysis of my portfolio over the months of each year with news impact. As you can see, those are the line of NFP, FOMC, and CPI. Okay, and this is very super useful insights. Like when you see people do trading, like maybe you see other people trading with FTMO or other prop firm, but I never seen someone doing this type of analysis on their portfolio, okay, or on their type of trading style, etc. So guys, this is like how real money are made. Okay, I'm just making a few during 2025, just made a few thousand euro, so it's like probably around 4,000 USD, and that's just the beginning. But like I did trading for over 5 years. Okay, I could reach this point just by only by learning during this process, during this time, and I learned a lot of things. And trust me, this is like the best thing to do, how to analyze data, because like for me doing something like this manually, it could have taken probably hundreds of hours, maybe even more. But when you learn how to manipulate your own data with Python, that's completely different. Even because this is just a visual, this is like useless, but machine learning I did machine learning with this code and this comparison here, and it built a new equity, finding the best solution, because those are the best solution. I have here the scenario comparison, and if you see, even the scenario with VIX, so the volatility index, were not that good. In the end, it performed worst. So yeah, but I didn't know before. There is so many things that I don't know about my strategy, but I want to know, I need to know if I want to trade with real money, that all of those comparison, all of those scripts here are super useful, even if sometimes they're not giving you good insights, like good advice. So yeah, that was the equity comparison, and trust me, was really useful. Then we have here another like super useful thing, and that's the MFE and MAE analysis. In this case, just like maximum favorable exposure, because like I was analyzing my payout frequency. So that's another super important thing. Sometimes when you have a prop firm account, so it's like a funded account, you think, okay, I'm gonna take money when I reach 2K because I think it's great. Okay, that's the worst things you can do. Okay, because like you're putting a target that doesn't make any sense. Fixed money target doesn't make any sense with markets. This is like a distribution, and there's a full script for this. Maybe I can show you if I find it. I have so many things here that like sometimes it's like hard to find everything. But yep. Okay, no, I didn't find the code for this graph here, but it was based on the MFE code, this one that I showed you in the first video. And wait, okay, this part here, so the conversion rate, it didn't work well. If you now I'm gonna show you the full code, so now you can just check it. I'm showing the full code, and you can just copy it and use it for your own trade and your own portfolio. Okay, yeah, it's like just 200 lines, like with code. And yeah, it's going to print like a full CSV file with all of the trades divided by strategy. I need it because I wanted to split my portfolio. So yeah, and then you're going to see something like this. This is based on daily MFE. Okay, so it's like how many times it's gonna touch a certain amount of currency. For example, here we got 0 to 200, and it touched that amount 500 times. Okay, and we have around 1,500 days. Okay, so 1,500 trading days, because it's over 6 years of time, and so it's counting only the trading days. But why this is useful? Okay, so you can think about you can think outside the box, and instead of having your own portfolio with all of the algorithms or EA or anything like that, that is gonna, okay, let's take like this share. So I was saying, instead of having your own portfolio, in this case, this is like my portfolio compared to different benchmark. In this case is S&P 500, Nasdaq 100, and then gold. So it's like the same performance that all of those assets made over the same period of time. And in this case, you can see, and you can say, oh, wait, you make less than the Nasdaq and less than the gold. Yeah, but if you can see how stable is my portfolio, you'll know that you can just double the risk, okay, still having a very low drawdown. In this case, you can see it here. So my portfolio return was 152%, okay, but with the drawdown of 3,000, okay, euro. The Nasdaq, same period of time, it did like a 70,000 euro of drawdown. Okay, so yep, it's very simple math. Okay, but I was saying about the MFE that you can easily use the same portfolio, okay, with the same trade, but then instead of letting the trade close by themselves with the algorithms, you can think, okay, let's analyze the MFE. Okay, in this case we did it here. Okay, and then you could say, okay, we know that 400 times we reach from 200 to 400 euro of profit. And in this case could be, let's close all of the position at 400 USD. I don't have here my equity curve with this type of if scenario, but I'm gonna show you maybe in the next video or something like that. Okay, those are the last two graphs I wanted to show you. So I'm not gonna show you anything else after. Those are still portfolio compared to different benchmark. In this case, we have here, in this case, we also have the, we also have USD JPY, and then we have the DAX. So this is German index. And as you can see, like, of course, equities are super correlated in a negative way with VIX. Okay, if you see here, this is the case of COVID-19, and the VIX spiked up like crazy, okay, like never before. And of course, like the equities lost money during that period. My portfolio did, of course, not of course, but I tried to build a portfolio, a robust portfolio, anti-black swan. Okay, so if you don't know what black swan is, you can look it online. Yeah, that's not super useful, but I did like a different type of analysis. So this is just like portfolio compared to VIX. Okay, and sometimes it did give you some insights. Those are machine learning metrics. Okay, this is the last graph I'm gonna show you. And this is not like super big insights. There is no machine learning. It's just like my equity curve compared to the other assets equity curve. Okay, and that's super nice to see. And I of course I knew that, okay, but like when you see your performance compared to the other assets performance, it's going to give you confidence, okay, on managing your own money, okay, because as you can see here, this is the 2020 year, and that's my portfolio compared to the other assets, so the benchmark in this case. And of course, like your own money, and of course in this case it did perform a little less, but if you can see the drawdown here is 10 times smaller, okay, yeah, and this is really good to see. Only in 2023 it performed very low compared, but then here you can multiply the risk by 5 times and still you're going to have a smaller drawdown compared to the other asset. And then if you multiply 7 by 5 times, you're going to reach like bigger performance. Still, maybe my portfolio in the same year in 2023 could have made less money than Nasdaq in this case, but then if you look all of the other years, is way better. So that's the end goal for everyone, having something that is outperforming the equity markets at least, because when you invest your own money, you don't want to have this type of drawdown 40%, 50%, I don't know, something like that. That's crazy to me. And I have money invested, but like I am trying to be as much professional as I can here, so I can move all of my money into my portfolio, okay, that is managed by algorithms but analyzed externally from different perspective, okay, and constantly analyzed by me, and of course machine learning, with the goal to be as conservative as I can, but still using leverage and make more money than the markets. So more money than my same amount of money invested in ETFs or index. So yeah, that's it. In the next video, I'm going to show you next analysis. Okay, this is like a little update. In this case, this is like a really nice visualization. In this case, that's wrong, okay? So the script is calculating wrong the first and original equity line, okay? But still, this is how powerful is it Python, okay? So you can have your own equity line plus the other. This is static optimization. This is like machine learning optimization, and then you have the drawdown comparison, and then all of the other metrics here, how you're using the MFE compared to the other scenario, so machine learning scenario, and then same thing for metrics, performance metrics comparison, and then MFE efficiency. That's like super useful insight. And then here is going to give you performance summary and recommendation, ML optimization. In this case, don't look at this because like it doesn't make any sense. Like it was calculating something wrong, so like it's going to be for the next update. So if you want to be really fast and also obtain results quicker and don't lose time, be sure to download all of your dataset first, okay? High quality, that's important. Small time frame, so M1 should be the best thing to do. I could have like ticks data, but ticks data is like insane because like probably 50 million row, okay? And so it's like you cannot do those analyses with ticks data with a basic computer or something, not even with a powerful computer, because like here you're analyzing, let's say 7 or maybe 10 or maybe 20 dataset at the same time and running script on that. So if it's like 50 million row, doesn't make any sense. Like it's gonna take ages. So those are little advice that I'm learning during these days, super useful for you if you are a beginner or something. Be sure to have good quality data and also small time frame, because like it's going to be more precise. And of course, download your own data, okay? If you're taking stuff from like Yahoo Finance and etc., it's going to be super slow, okay? and then be really organized. I use AI to do all of this structure. Okay, you see all of those are in the same script area, and some of them are completely different. So this is like a rescaler target, it's like a different thing. And then I have the MAE and MFE, and then equity curve is like, be sure to have everything organized, because if you want to find something, you're gonna find it much quicker if you are organized. I think that's a good advice. And then the other thing is, like with Python, don't look for new strategy. Okay, so before looking for new strategy, analyze your own trading portfolio. Okay, or maybe if you're trading manually, you can analyze your own track record, so it's like your history. Okay, and then try to think outside of the box and put as many if scenario as you can. So let's replicate the 2008 crisis scenario. So you are trying your own strategy on that crisis. Same thing for dot-com bubble or something like that. Okay, so you're trying to analyze your portfolio during different scenario. Okay, and then if you see some weak spot, okay, like I'm gonna show you my weak spot is, I think, in 2023. Let's see, should be exactly here. You see, this is minus 388 euro. Okay, that's my lowest equity drawdown. So the equity drawdown dropped around 1,000 euro below. Okay, so the year still closed really good with a really good performance, because it made, this is counting from, I think, 100k from the beginning. Oh, that's wrong. But still, it was a good year anyway. But for me, this is my weak spot. And each year there's a weak spot. In this case was a little less, but the goal is to analyze all of the drawdown and compare them to the equity. So this is like the overall performance. But then you're going to have a weak spot in this, like in this case, and you want to analyze. And then when you reach this point here and you analyze this compared to other factors, or maybe other benchmark like VIX, and then other benchmark like S&P or other equities, at that point you can think about, okay, let's build a strategy that perform well, or maybe that is gonna perform well in this type of scenario. Okay, as the first few days, but I have equity compared to different economy scenario. So in this period we were in a quantitative tightening. Okay, so the Fed, the Federal Reserve in the US, was increasing the rate, the CPI over CPI, that interest was increasing. Okay, because they wanted to decrease the inflation. Okay, and so they were increasing the interest on the debt, and so my portfolio performed really bad in that time.